All right, welcome back to The Explainer. Today, we are strapping in to look at Riot platforms. And honestly, the financial reality we're about to look at is absolutely dizzying. So if you're looking for a calm, steady, predictable ride, well, you're definitely in the wrong place. We're going to uncover a financial profile that pretty much defies conventional logic. It's this wild mix of spectacular growth on one hand and just staggering losses on the other. But to really get why investors keep flocking to this company, we got to start right here. Check out this massive stock return back in 2020. Over 1,400%. I mean, that is a gravity-defying number. It's the exact kind of explosive lottery ticket growth that would hook absolutely any investor looking to make life-changing gains in a single calendar year. But flash forward just 2 years later to 2022, and the floor completely drops out. A devastating crash of almost negative 85%. Just imagine that for a second. Imagine watching your portfolio multiply by 14, only to see the vast majority of it just completely evaporate right in front of you. This wasn't just a minor dip, right? It was a massive, brutal erasure of market value. So, today we're putting on our financial detective hats. We need to figure out exactly how a single company can produce such extreme, whiplash-inducing volatility. And hey, we aren't going to rely on market rumors or online hype. We are going straight into the raw financial data to pull apart the mechanics of this machine together. Section 1, the price roller coaster. Let's dig right into that historical data. Scanning these yearly returns, it brilliantly illustrates that these wild swings, they aren't some weird fluke. They're actually a historical feature of the stock. Look at this, up 1,416% in 2020, then down 84% in 2022, up 356% in 2023, down 34% in 2024. You'd literally need motion sickness medicine to hold this long term. In fact, despite all those massive upward spikes, if you look at the 5-year total return, it's actually sitting at negative 53%. So it's a day trader's absolute paradise for sure, but kind of a buy and hold investor's worst nightmare. Moving on to Section 2, massive revenue growth. Because we have to ask, what keeps drawing investors back onto this crazy ride? Well, the answer is explosive top-line growth. This is the bait. Over the trailing 12 months, Riot brought in nearly $647 million. But look at these growth rates. A 3-year compound annual growth rate of over 35%. And a massive 121% growth rate over 5 years. Those are pure hyper-growth metrics. When a company doubles its revenue base that incredibly fast, the market naturally pays attention. They're making a bet that all this massive scale will eventually turn into a giant mountain of cash. And this brings us to Section 3, the profitability problem. Because as we peel back the layers and look at the bottom line, the story takes a pretty challenging turn. Now, the stark contrast here is just fascinating. On the surface, things actually look okay. Riot earns a solid 35% gross profit margin on its core operations. So after paying for the direct costs of their services, they keep about a third of their revenue as profit. Not bad. But the absolute second you factor in all the other costs of running the business, the entire operation just bleeds cash, landing them at a deeply negative 30% net profit margin. So basically, for every dollar they make, they're ultimately losing about 30 cents. Ouch. Which perfectly tees up Section 4, cash flow and valuation. Let's look at the absolute numbers to wrap our heads around the sheer scale of what it costs to keep these operations running. And this visual right here, this is a heavy reality check. On the left, sure, we have that impressive $647 million in revenue from the last 12 months. But on the right, the terrifying reality. They burned through nearly $930 million in free cash flow over that exact same period. Just let that sink in for a second. They are spending almost $1 billion more in cash than their actual operations are generating. That is an astonishing, frankly terrifying rate of cash burn. And you know, this massive cash burn reflects everywhere across their financial health indicators. Trailing 12-month net income, a staggering loss of over $663 million. On top of that, their return on equity is negative 23%, and return on assets is negative 17%. Now, these aren't just slight little inefficiencies. These metrics are screaming that the company is actively destroying shareholder value right now and totally failing to generate a return on the massive asset base it's built up. All right, Section 5, decoding the bottom line. So how in the world does the market even price a company that is growing its revenue exponentially while burning cash just as fast? Let's check the numbers. A negative PE ratio of 9.07 is a quick reminder that, well, there are no actual earnings here to value. We are firmly in the red. Yet, look at the price to sales ratio. It's sitting at almost 12. That means investors are still perfectly willing to pay almost $12 for every single dollar of sales this company generates, completely ignoring the fact that those sales are unprofitable. They are paying a massive premium just to get a piece of the action. And if we really want to see just how stretched this valuation is getting, we have to look at EV to EBITDA. As a quick refresher, this metric compares the company's total overall value, its enterprise value, to its core operational earnings, stripping out the noise like debt costs, taxes, and non-cash depreciation. It's usually the purest way to see what the market thinks the core money-making engine is actually worth. And for Riot, that number is sitting at an absolutely astronomical 361.88. Now, for some context here, a healthy, normal company might trade at maybe 10 or 15 times its EBITDA. 361 times means the market is paying a massive, highly speculative premium purely based on future potential. Investors are completely ignoring current operational costs and betting the whole farm on some miraculous future turnaround. So, synthesizing all our data today, we're basically looking at two completely different companies fighting for dominance on the exact same balance sheet. On one hand, you have the sizzle, right? A staggering 121% five-year revenue growth rate and a decent gross margin proving their core service actually generates a premium. But then, change directly to it is the reality. Nearly $1 billion in negative free cash flow over 12 months and a net margin of negative 30%. It is a total financial paradox. Which leaves us with this final, absolutely critical puzzle to ponder as we wrap up today. Can a company truly just grow its way out of a billion-dollar cash hole? Is this dizzying exponential top-line growth actually worth the massive bottom-line cost? Or will this spectacular financial roller coaster eventually just run completely out of track? It's a high-stakes question, for sure. And looking at the data, it seems like this wild ride is far from over.